Guys, I'm here to do 5 stocks and where the entry points are based on our stock analyzer tool. If you subscribe to our software, please open stock analyzer tool, follow along. If you don't, you're going to love this. First stock, Costco. This is a love of Charlie Munger. Charlie Munger loves this company, owns a lot of it. So let's go to Costco and the 8 pillars. And again, follow along if you have our software. And if you don't, you're going to learn a great deal about our software and how awesome it is. So Costco's fallen a lot recently in the last few months. 612 high, a low of 377. It's currently at 469. It was down today at $1.15. Now it's only down 270. So it pays a dividend of $1.4 billion, about 0.7%. And it looks like they can easily afford it based on their $4 billion in free cash flow. It only eats up 30-35% of free cash flow. Now, something different than most retailers, high return on invested capital, 14%. If you wait for our next ones that are grocers, way lower return on invested capital. But let's go to the 8 pillars tab to see what's going on. So first off, just seems expensive. 50 times 5-year earnings and 50 times the 5-year free cash flow. And they've also issued just a few shares. They haven't diluted people that bad. 1.1% increase in shares outstanding. So let's go right to the stock analyzer tool. Again, every investment is the present value of all future cash flow. I hear this in our community all the time from our community members. Over 12,000 people have signed up. And they always say, remember, Uncle Paul says every investment's the present value of all future cash flow. The stock analyzer tool allows us to make assumptions about revenue growth, profit margin, and free cash flow margin. Because remember, if our revenue growth, as our revenue increases, what's going to happen to our profit? It's going to increase. What's going to happen to our free cash flow? It will increase. So the stock analyzer tool allows it estimates based on your assumptions, all those revenue and profit numbers, and then takes it back to today and tells you what you should pay today based on the return you want. That is the whole point of the stock analyzer tool. Okay, so now for my assumptions in here. Well, what are my assumptions going to be? We list here the 1, 5, and 10-year numbers for revenue growth, profit margin, and free cash flow margin. My goal is to look at these and say, okay, based on this, I want to make a very low number. Now, you might sit there and say, well, Paul, 8.4% the lowest. True, but Costco's grown a lot in the last 10 years. Do I think that growth is going to continue? I want to be conservative. So I'm going to sit there and say 4%. Now, middle one, I might say 7% and a high of 10% because they open a lot of stores and inflation takes over. Their revenue will probably jump up quite considerably. But that's probably going to be hard to happen. So that's why I picked 4, 7, and 10. I think 4 is a very reasonable number. 7 is they could probably do that. And 10 is hey, they hit it out of the ballpark. They got a few tailwinds. It could happen. Profit margin. Guys, look at their profit margin. It's pretty much all the same. So I'm going to stick in the low to mid. I'm going to do 2.2, 2.4, and 2.6%. Free cash flow. Now, guys, unless there's a major difference in the numbers I see up here, I'm probably going to put the same free cash flow percentage as profit margin. Why? Because over long periods of time, free cash flow and earnings should be very, very similar. So now for PE. Now, guys, the current PE in the company is 37. So don't fall into the trap that I used to fall into. That, this 37 PE, 25 is a discount. No. What you should base it on is the historical average for the markets. In a company like this has a good brand, but it doesn't have a lot of growth rate. So I would sit there and take it to more normal less numbers in history, 13, 15, and 17. And the same with free cash flow. As boring as crazy that sounds, trust me when I say that over long periods of time, companies like this that aren't sexy, don't have tons of growth, and really have low margin should not sell at very high multiples. Okay? And it's evidence in the fact the company used to be $600 and some a share, and now it's $420 just a few months later, $450 just a few months later. And our final metric, desired annual return. Guys, make this whatever you want. But what I encourage you to do is you can get 9 or 10% from an S&P 500 ETF over long periods of time. So give yourself some margin of safety and give yourself some decent return for doing an individual stock and do at least 12.5%. The riskier the stock, the higher your return should be. Hit the analyze button. And again, the stock is 470. And look at this. 135 on the low side, 285 on the high side, and about 200 somewhere in the middle. So you might sit there and say, geez, Pete, there's no way it's going to happen. First off, I'm going to add this stock at 285 to my watch list. It's going to notify me an email on the app. Doesn't mean I'm going to buy it at that level. It just means I'm going to go do more research. But keep in mind, before you sit there and say 250 won't happen, look at the stock. Just months ago, twice in April was over $600 a share, and it got as low as $416. That's a 33% drop in 2 months. That can happen. Somebody just said, wow, in our studio. That's exactly it. Stocks can fall, and when they fall hard, especially overvalued ones. Just be patient. Kroger. So Kroger Company, KR. Let's look at their chart. Look at that. A high of $63 and a low of $36 in the last 1 year. So we're going to go right to the 8 pillars. So some X's, a low return on invested capital, which I expect for this kind of industry. Net income has dropped only $250 million over the last 5 years. I know that sounds like a big number, but for a company that does $138 billion in revenue in a year, that's not a big deal. A little bit higher debt, but it could be because of leases. You know, Kroger has big stores, big leases. It might not be a bad thing, but they're buying back shares like a mug. Look at that. 21% of their shares are being bought back in the last 5 years. Cash flow is up $3 billion. Price of free cash flow 17, PE of 20 over the last 5 years. So guys, I'm liking this so far. One thing, dividend yield. They pay a 1.6% dividend yield. It's $589 million versus their average of $2.24 billion. So they can easily afford this dividend yield. So let's go to Stock Analyzer tool. Let's put some assumptions in. 10-year analysis, follow along. So revenue growth, I'm going to go 2, 3.5, and 5%. Profit margin, guys, grocery stores are very low profit margin. I'm going to do 1.25, 1.5, and 1.75. Free cash flow, I'm going to do the exact same numbers because, guys, over long periods of time, free cash flow and earnings should be very similar. Now, all I did here to make these assumptions was just look at their 1, 5, and 10-year numbers and feel where they're at. That's basically what it is. Remember, it's a starting point, guys. It's not a set in stone. You're trying to figure out, hey, does this attractive to me? Should I go further in this? And we're going to do this in every other stock we do, the other 4 stocks we do today. Just look at the 1, 5, and 10-year numbers and kind of get a feel for things and be a little bit more conservative on the low side, a little bit more aggressive on the high side, and somewhere in the middle. Very simple. Now, for PE. Guys, the PE of the company is currently 23. That is not an ongoing long-term PE. With companies that have high growth or a big moat, I would encourage a high PE. But this company doesn't have that. But they are quite the brand. So I'm still going to stick on conservatively 13, middle being where the market is at 15, and 17 on the high end. And guys, like I said, I want to do the same thing for the price of free cash flow. Now, finally, desired annual return. You can get 9 or 10% by investing in the market. So I want to have a little bit of margin of safety and an incentive to buy an individual stock. So I like to go 12.5% overall. And I do that for every single metric. I hit the analyze button. The stock is currently at $51.70. Low price of 25, a high price of 50, and 36 is somewhere in the middle. So if I want to follow the stock at 36, I hit the plus mark, add it to my watch list. I will get notified at $36.15. Notify me through email and through the app. Stock number 2. ACI. ACI is another retail grocer. So let's go look it up. ACI, Albertsons. Now, Albertsons, remember guys, profit margin, same thing, grocery stores. They have a dividend of 2.2%, which pays out $322 million, which is a little bit bigger than their 5-year average, which is a little bit bigger percentage of their 5-year average than Kroger. Return on invested capital, again, low. So let's go to the 8 pillars immediately. 8 pillars tab, pretty similar, guys. Very similar, buying back shares. The only difference is I believe their revenue growth or their net income growth was better than Kroger, but overall pretty much online. A lot of debt, probably because of leases. So let's go right to the stock analyzer tool. 10-year analysis. I'm going to do the same 2, 3.5, and 5%. Profit margin. I'm going to keep the profit margin at what the low numbers of 1.25, 1.5, and 1.75. Same with free cash flow. And then, guys, look at their PE. Much lower PE than Kroger and much lower price of free cash flow. Now, still, I'm going to put a 13, 15, and 17. So you might sit there and say, whoa, it's a lot higher than what they're currently at. So part of the 8 pillars is to tell a story. So before I buy this company, I'm going to sit there and say, is there a reason why their PE is so low in price of free cash flow? There might be a reason, like they're declining sales in same store. For all the retail companies we're doing, I recommend find their same store sales. That is a sales growth or loss based on stores that have been open for a while. Because it's easy to open stores and show revenue growth. The question is, are the stores that currently exist still growing? And again, my 12.5% return. The stock is currently at 30. Hit the analyze button. Oh boy, look at this. We have a 40 on the high side and a 20 on the low side. And it's pretty close to the middle number here too. So again, I'm going to add it to my watch list on the middle tier, $28.79. Notify me when it's below. I'm going to get an email and a text on my app when that happens. Our 4th stock, Walgreens. So let's go up here to Everything Money. Again, follow along. WBA, Walgreens Boots, another company that's had a lot of ups and downs the last year. A high of 55, a low of 39, pays a healthy dividend of 4.4%. The good news is, guys, they can afford that dividend. 1.6 billion. Last year they had 3.6. In the last 5 years, they've averaged 4.7. So it looks like that dividend is probably pretty safe. I like to see it under 50% of the cash flow. All right. So let's go right to the 8 pillars tab. All right. So a few X's here. What are the X's? Low return on invested capital. I think you're seeing a pattern in retail. High debt. Again, pattern in retail because of leases. And cash flow growth has dropped. So this is my first one. I'm going to go, okay, I'm going to want to go to the cash flow statement and realize what that is at some point. But look at this. They bought back 20% of their shares in the last 5 years. That's big stuff. So let's go to the stock analyzer tool and do the analysis, 10 years. I'm going to go 2, 4, and 6%. Profit margin, 3, 2.75, 3, and 3.25. Free cash flow margin looks a little bit better than profit margin, to be honest. So I'm going to go a little bit more aggressive. PE, 13, 15, 17. Now, guys, look at my consistency. Look at the PE currently. It's 6. And I went and put 13, 15, 17. Unless Walgreens, I do more research, and they have some massive problem that I don't see, this should not be a 6 PE company. So I'm going to use this as my opportunity to possibly buy shares at a lower price. And finally, 12.5% return on my money, like usual. Hit the analyze button. The stock's currently at $43. What do we have here, guys? All green, baby. So what do you do here? Well, you go do more research. Sounds boring, but make sure you're not missing something because this all screams great stuff, but there could be something in there. What if it all of a sudden said in there that they've done something that's just hurting people and causing major problems, and they're facing $100 billion in lawsuits. You got to be able to know those things. The great news is it doesn't take much digging. Go do scuttlebutt. Go on Google. Go research things about Walgreens. Go to their 10K. Skim it. Go to our community. Join our community and talk to people about Walgreens. You can go in there and search WBA or Walgreens. It'll take you right to the conversations that are happening and ask the other 12,000 people who've signed up, hey, what are you seeing in Walgreens? Very simple stuff. Our final stock is CVS. And guys, all you do here in our software, go right up here, CVS, click it. Boom, we're on CVS now. Let's go with the 8 pillars. So, does this look familiar? Low ROIC. Lots of debt. Now, here's the deal. Issuing a lot of shares. Now, spoiler alert, they issued a lot of shares, though, because of an acquisition. I think that was the case. So that's why their shares are higher. But this would have told you in our software, wait, why are the shares higher? Let me go do research on that. But everything else seems pretty decent. The PE is a little bit higher, but the price of free cash flow is lower. They have a 2.1% dividend. Guys, look at this free cash flow this company has. $10 billion average over the last 5 years, and they only pay $2.7 billion out in dividends. That's pretty incredible. So let's go to the stock analyzer tool, make our assumptions, and see what we're willing to pay. Oh, wow, much bigger revenue growth. But I think they also, again, the acquisitions we made here, they made acquisitions here that really jumped up their revenue. So they can't exactly be carried through. Remember that. When you're looking at revenue growth, that seems high compared to Walgreens. They made a lot more acquisitions. So I'm going to go 2, 3.5, and 5. Profit margin, 2.2, 2.4, 2.6. Free cash flow margin. I'm going to be a little bit higher on this one. 3.5, 4, and 4.5. PE, 13, 15, 17. And again, 13, 15, 17 on price of free cash flow. And our final 12.5% return on our money for this stock. Hit the analyze button. The company's currently at 95. And there is some green here, but wide ranges because of the differences between profit margin and free cash flow. We have a low of 55 to 85, a high of 90 to 160, and a mid-range of 70 to 120. Guys, these are wide ranges, but this is the analogy I love to use when it comes to, is the stock overpriced or not? If I told you right now to make a $10,000 bet, if I weighed 170 over or under, would you take that bet? You'd be like, But if I asked you to make a bet right now at 100 pounds, bet $10,000 on the over or under, do I weigh more than 100 pounds? You'd be like, yeah, I'll make that bet all day. He's over 100 pounds. That's the point. We don't know exactly what intrinsic value is. You don't know exactly what my weight is, but you should invest in a company when it's pretty obvious that it's underpriced. And right now, I don't see that obviousness here for CVS. Does that mean you ignore it? No. Pick the price where you sit there and go, at this price, it's pretty obvious. Here, that's $70. So I'm going to add that to my watch list at $70. If you were the same as I was before and you didn't have a process and lost money and it frustrated you, Come watch our 8-pillar process. Come watch our channel. You'll learn a lot more and you'll have a better process.